Thank you for standing by. My name is Cole, and I'll be your conference operator today. At this time, I would like to welcome everyone to Supermicro Computer Fiscal Second Quarter 2024 results. With us today, Charles Liang, Founder, President, and Chief Executive Officer, David Wicken, CFO, and Michael Staiger, Vice President of Corporate Development. All lines have been placed on mute to prevent any background noise. After the speaker's remarks will be a question and answer session. If you'd like to queue for a question, please press star 1 on your telephone keypad. It has been asked that we keep ourselves to one question and one follow-up question. And with that, I'd like to pass the call over to Michael Staiger.
Good afternoon, and thank you for attending Supermicro's call to discuss financial results for the second quarter, which ended December 31st, 2023. With me today are Charles Liang, Founder, Chairman, and Chief Executive Officer, and David Wicken, Chief Financial Officer. By now, you should have received a copy of the news release from the company that was distributed at the close of regular trading and is available on the company's website. As a reminder, during today's call, the company will refer to a presentation that is available to participants in the Investor Relations section of the company's website under the Events and Presentations tab. We've also published management's scripted commentary on our website. Please note that some of the information you'll hear during our discussion today will consist of forward-looking statements, including without limitation those regarding revenue, gross margin, operating expenses, other income and expenses, taxes, capital allocation, and future business outlook, including guidance for the third quarter of fiscal year 2024 and the full fiscal year 2024. There are a number of risk factors that could cause Supermicro's future results to differ materially from our expectations. You can learn more about these risks in the press release we issued earlier this afternoon, our most recent 10-K filing for fiscal 2023, and our other SEC filings. All of these documents are available on the Investor Relations page of Supermicro's website. We assume no obligation to update any forward-looking statements. Most of today's presentation will refer to non-GAAP financial results and business outlook. For an explanation of our non-GAAP financial measures, please refer to the accompanying presentation or the press release published earlier today. In addition, a reconciliation of GAAP to non-GAAP results is contained in today's press release and in the supplemental information attached to today's presentation. At the end of today's prepared remarks, we will have a Q&A session for sell-side analysts to ask questions. I'll now turn the call over to Charles.
Thank you, Michael, and good afternoon, everyone. I'm delighted to share our second quarter results, which show a record-breaking performance for Supermicro. We achieved revenue of $3.66 billion, a 103% increase from last year, and earnings per share of $5.59. This is our first quarter ever with over $3 billion revenue. More importantly, this single quarter's revenue surpassed our annual revenue for 2021. This fantastic quarterly result was driven by strong demand and improving supply conditions for GPU and related key system components. Our rack-scale plug-and-play IT and AI total solution continues to gain more new customers, along with their confidence in Supermicro as their go-to infrastructure partner. Our AI rack-scale solutions, especially the deep learning and LLM optimized based on NVIDIA HGX H100, continue gaining high popularity. The demand for AI inferencing systems and mainstream computer solutions has also started to grow. The exciting news is that finally we are entering an accelerating demand phase from many more customer wins. To support faster growth, we have increased our working capital recently by raising about $600 million with an equity offering. Moreover, we have other programs to increase our cash flow without additional equity dilution to support short and long-term sustainable growth. Overall, I feel very confident that this AI boom will continue for another many quarters, if not many years. And together with the related inferencing and other computing ecosystem requirements. Demand can last for even many decades to come. We may call this an AI revolution. Let's go over some key financial highlights. First, fiscal Q2 net revenue total $3.66 billion, up 103% year-on-year and up 73% quarter-on-quarter, exceeding the top end of our original guidance of $2.9 billion for December quarter. Second, fiscal Q2 non-GAAP earnings of $5.59 per share were well above $3.26 a year ago and exceed the guidance range of $4.40 to $4.88, further demonstrating continual strong operation leverage. Economic of scale is important to us for continual strong growth. Supermicro is at the forefront of the AI revolution, where the pace of innovation is accelerating. We are heading the race by developing the most innovative AI infrastructure on many platforms at rack scale for almost any industry and for any market vertical. As the market leader, we have been preparing to more than double the size of our current AI portfolio, with the coming soon NVIDIA CG1, CG2, Grace Hopper Superchip, H200 and B100 GPUs, L40S inferencing optimized GPUs, AMD MI300X, MI300A, and Intel Gaudi 2 and Gaudi 3. All these new platforms will be ready for high volume production in the coming months and quarters. Moreover, we are adding further optimized new architectures for the coming NVIDIA GPU product lines. Our AMD MI300X system are sampling now, and our Intel Gaudi 3 system is coming soon. More importantly, we are continuing to invest and innovate in data center and enterprise liquid cooling technology to make sure these high-power AI platforms are in line with our green computing methodology, while improving the performance, efficiency, and reliability of systems in a data center. As a total IT solution innovator, manufacturer, and provider, more and more of the major deployments is being delivered as an integrated rack solution, particularly for the AI cluster deployments. Servers, networking, storage, security features, and software are optimized, validated, delivered, and serviced as an integrated rack cluster from Supermicro's manufacturing facility worldwide. Leveraging our building block architecture and operating production automation system, we can deliver optimized rack solution with time to market and quality advantages for our customer more efficiently than competition. Our TTD, time to delivery factor, have been in a continuous improvement. But this June quarter, we will have high volume dedicated capacity for manufacturing 100 kW to 120 kW rack with liquid cooling capability, providing DLC, direct attached liquid cooling rack capacity up to 1,500 rack per month. And our total rack production capacity will be up to 5,000 racks per month by then. At the same time, our high volume clean room rack scale production facility will be ready to service critical customer very soon. The rapid growth of our business is driven the need of additional R&D, solution optimization, manufacturing, and service capacity. Today, our production utilization rate is about 65% across our USA, Netherlands, and Taiwan facilities, and they are quickly finished. To address this immediate capacity challenge, we are adding 2 new production facilities and warehouse near our Silicon Valley headquarters, which will be operating in a few months. The new Malaysia facility will focus on expanding our building blocks with lower cost and increased volume, while other new facilities will support our annual revenue capacity above $25 billion. To summarize, our record quarterly performance demonstrates our building block, rack scale, plug and play IT and AI industry leadership, which continues to accelerate and show signs of strong market share gains. The continued strength of existing customer build and ramp of newly acquired customers, and a robust pipeline of new products coming in 2024, giving me confidence that fiscal Q3 revenue will be in the range of $3.7 billion to $4.1 billion. Additionally, we are expecting continued strength for the second half of fiscal 2024, and now forecast revenue for the full fiscal year ending in June to be in the range of $14.3 billion to $14.7 billion. We are in overdrive to accelerate the Supermicro 3.0 business model with this AI boom. At the meantime, we are preparing ourselves for the next phase of Supermicro business growth with Supermicro 4.0 and its expanding TAM. Now is certainly the most exciting time yet for Supermicro. Before passing the call to David Weigand, our CFO, I want to thank again to our partners, our customers, our Supermicro employees, and our shareholders for your strong support. Now let me pass to our CFO, David, for more financial details.
Thank you, Charles. Fiscal Q2 2024 revenues were $3.66 billion, up 103% year over year and up 73% quarter over quarter. Revenues were higher than our initial guidance of $2.7 to $2.9 billion and slightly above our recently updated guidance of $3.6 to $3.65 billion. Our growth was driven by demand from new and existing customers for our leading AI and rack scale total IT solutions and an improving supply chain. Next generation AI and CPU platforms continue to drive strong levels of design wins, orders, and backlog from top-tier data centers, emerging cloud service providers, enterprise channel, and edge IoT telco customers. During Q2, we recorded $1.48 billion in the enterprise channel vertical, representing 40% of revenues versus 43% last quarter. This was up 55% year over year and up 62% quarter over quarter, driven by enterprise AI and CPU upgrade programs. The OEM appliance and large data center vertical revenues were $2.15 billion, representing 59% of Q1 revenues versus 55% last quarter. It was up 175% year over year and up 83% quarter over quarter. Two existing CSP/large data center customers represented 26% and 11% of total revenues for Q2. Emerging 5G telco edge IoT revenues were $35 million, or 1% of Q2 revenues. Growth was driven by AI, GPU, and rack scale total IT solutions, which again represented over 50% of total revenues this quarter, with AI GPU revenues in both the enterprise channel and the OEM appliance/large data center verticals. Server and storage systems comprised 94% of Q2 revenue, and subsystems and accessories represented 6%. ASPs increased on a year-over-year and quarter-over-quarter basis, driven by product and customer mix. By geography, the U.S. represented 71% of Q2 revenues, Asia 18%, Europe 8%, and the rest of the world 3%. On a year-over-year basis, U.S. revenues increased 139%, Asia increased 98%, Europe decreased 8%, and the rest of the world increased 67%. On a quarter-over-quarter basis, U.S. revenues increased 61%, Asia increased 191%, Europe increased 51%, and the rest of the world increased 37%. The Q2 non-GAAP gross margin was 15.5%, which was down quarter-over-quarter from 17%, as we continued to focus on winning strategic new designs and gaining market share. Turning to operating expenses, Q2 OpEx on a GAAP basis increased by 6% quarter-over-quarter and 58% year-over-year to $193 million, driven by higher compensation expenses and headcount. On a non-GAAP basis, operating expenses increased 18% quarter-over-quarter and 41% year-over-year to $153 million. Q2 non-GAAP operating margin was 11.3% versus 10.8% last quarter, as we benefited from operating leverage driven by higher revenues. Other income and expenses for Q2 was a net expense of approximately $16 million, consisting of $8 million in interest expense and a loss of $8 million principally from foreign exchange. Interest expense increased sequentially as we drew down on short-term bank credit facilities for working capital during the quarter. The tax provision for Q2 was $61.5 million on a GAAP basis and $71.1 million on a non-GAAP basis. The GAAP tax rate for Q2 was 17.3%, and the non-GAAP tax rate was 17.8%. Q2 non-GAAP diluted EPS of $5.59 exceeded the high end of our initial guidance of $4.40 to $4.88, and slightly above our recently updated guidance of $5.40 to $5.55 due to operating leverage. Cash flow used in operations for Q2 was $595 million, compared to cash flow generated by operations of $271 million during the previous quarter. Strong profitability and a higher level of accounts payable was offset by higher inventory and accounts receivable due to build plans for Q3 and the timing of shipments during Q2. CapEx was $15 million for Q2, resulting in negative free cash flow of $610 million versus positive free cash flow of $268 million last quarter. During the quarter, we executed an equity offering and raised approximately $583 million in net proceeds after underwriting discounts and other issuance costs from the sale of 2.3 million shares at a price of $262 per share. The proceeds will be used to strengthen our working capital, enable continued investments in R&D, and expand global capacity to fulfill strong demand for our leading platforms. The closing balance sheet position was $726 million, while bank debt was $376 million, resulting in a net cash position of $350 million versus a net cash position of $397 million last quarter. Turning to the balance sheet and working capital metrics compared to last quarter, the Q2 cash conversion cycle was 61 days versus 86 days in Q1. Days of inventory decreased by 24 days to 67 days versus the prior quarter of 91 days due to the timing of shipments during the quarter. Days sales outstanding was down by 14 days quarter-over-quarter to 29 days, while days payables outstanding decreased by 13 days to 35 days. Now, turning to the outlook, we expect a strong March quarter as we continue to gain momentum with new and existing customers for our AI and rack scale total IT solutions. For the third quarter of fiscal 2024, ending March 31, 2024, we expect net sales in the range of $3.7 billion to $4.1 billion. GAAP diluted net income per share of $4.79 to $5.64, and non-GAAP diluted net income per share of $5.20 to $6.01. We expect gross margins to be slightly lower than Q2 levels. GAAP operating expenses are expected to be approximately $201 million and include $39 million in stock-based compensation expenses that are not included in non-GAAP operating expenses. The outlook for Q3 of fiscal year 2024 diluted GAAP EPS includes approximately $28 million in expected stock-based compensation expenses, net of tax effects of $14 million, which are excluded from non-GAAP diluted net income per common share. We expect other income and expenses, including interest expense, to be a net expense of approximately $9 million. The company's projections for Q3 GAAP and non-GAAP diluted net income per share assume a GAAP tax rate of 13.8%, a non-GAAP tax rate of 15.8%, and a fully diluted share count of 60.1 million for GAAP and 61 million for non-GAAP. We expect CapEx for Q3 to be in the range of $18 to $21 million and a range of $105 to $115 million for the fiscal year 2024. For the fiscal year 2024, which ends June 30, 2024, we are raising our guidance for revenues from a range of $10 to $11 billion to a range of $14.3 to $14.7 billion. Michael, we're now ready for Q&A.
Cole?
If you'd like to queue for a question, please press star followed by 1 on your telephone keypad. If for any reason you'd like to remove that question, please press star followed by 2. Again, to join the queue for a question, please press star 1. It's also been asked to keep yourself to one question with one follow-up question. We'll pause here briefly as questions are registered. Our first question is from George Wang with Barclays. Your line is now open.
So hey guys, congrats on the quarter and the strong guide. I have two questions. Firstly, can you talk about kind of supply versus demand? Obviously for the December quarter, probably driven by both kind of improving supply and also strong demand. So if you can, maybe you can talk about backlog level and also on the supply side, are there still ongoing constraints right now?
Yeah, thank you for the question. Indeed, the demand is still stronger than supply. So if we have more supply, we will be able to ship more. And we are very happy to continue to grow our capacity, work out better, even higher support, so to grow business even quicker.
Okay, thank you. And quickly a follow-up just on the liquid cooling. You talk about kind of expanding to 1,500 racks per month after June this year. And maybe you can talk about your expectation for the total production mix from liquid cooled racks by year end. And also maybe you can talk about kind of the difference, so the config within the liquid cooling. I know you guys have some immersion cooling and air to liquid cooling, so maybe you can double click on this thematic topic going forward.
Yeah, thank you, George, for the question. Indeed, the liquid cooling, we are leading the industry. So we have a huge capacity ready and have a very mature total solution ready. But lots of customers already like liquid cooling, but their data center need some more time to be ready. I mean, their infrastructure need some more time. So we believe liquid cooling will be the trend, and we continue to make ourselves ready and try our best to support the customer, including provide some help to their data center infrastructure. So I believe liquid cooling percentage will continue to grow. But at this moment, most of the shipping still air cool.
Okay, great. Thank you. I'll go back to the queue.
Thank you.
Our next question is from Samik Chatterjee with JP Morgan. Your line is now open.
Hi, thanks for taking my questions and congrats on the strong results here. Maybe if I can just start with the gross margin, and you did have a step down here in 2Q. You're guiding to a slight moderation to 3Q. Maybe just help me understand as a management team, how do you think about balancing the opportunities that you're going for in terms of market share wins and design wins relative to sort of being growing profitably over the long run? How are you sort of evaluating those opportunities side by side? And then I have a follow-up. Thank you.
Sure. Thanks, Samik. So when we win a new customer, we always try to go in and out, and so we go into the organization and try to spread out into different divisions. And so in order to do that, as we take on new customers, we do evaluate and try to win the business, which requires us to be competitive. And so we always are balancing in the interest of shareholder value how to maximize that. And so at this time, we are growing really quickly, and in order to do that, in order to take market share, we will take opportunities by being more competitive on pricing.
Yeah. The good thing is that when we continue to grow our economical of scale, the operation margin indeed will be still able to keep in a healthy position.
Yeah, got it. And then just more near-term question. When I look at the revenue guide for 3Q and 4Q, there's a step up here in revenue of about sort of call it $500 million, a bit less going from 2Q to 3Q, and then a bigger step up to get to the midpoint of the annual guide into 4Q. How much of that is driven by just being a bit more cautious about when supply comes in and pushing that the revenue guide a bit more to the 4Q, or is that really what the visibility currently tells you in terms of supply? I'm just trying to get sort of what's driving the cadence from 2Q to 3Q to 4Q and the guide that you've provided today. Thank you.
Yeah. So Samik, we have a very large and growing backlog, which grew again this quarter. And so really, as Charles mentioned earlier, our only constraint is supply. However, the good news is that supply is improving. And so to your point, we have to be somewhat conservative because we are constrained still by supply.
Good. Thank you. Thanks for taking my questions.
Our next question is from Nehal Chokshi with Northland. Your line is now open.
Yeah, thanks, and great, impressive guidance, and thanks for explanation regarding the dynamic on the forward guidance for both the March quarter and plus the June Q guide. Looking at the incremental revenue for the December quarter, Dave, you already alluded to this, you're making shareholder accretive decisions. So that's what's driving the tick down in the gross margin, yet your operating margin has improved Q over Q. And so just to be clear, when you're talking about making shareholder accretive decisions, it's still with respect to current revenue, not just simply looking at future free cash flows associated with future revenue follow on from these lower margin opportunities. Is that correct?
It's really about trying to return the most shareholder value. So back to your point, we know that because of our tight control over operating expenses, if we get more volume from a large customer, we're going to be able to bring more EPS to our shareholders. So that's really the decision to partner with a really good customer.
Got it. Okay. And then did you review the 10% revenue customers for the quarter?
We did. Yeah, we said we had two, 125 and 111, both in the CSP large data center vertical.
Great. Thank you for taking my question. I'll get back in the queue.
Our next question is from John Tanwanteng with CJS Securities. Your line is now open.
Hey, good afternoon. Thank you for taking my questions, and really congratulations on the fantastic growth. Charles, my first question is for you. I was wondering what gives you the confidence into growth beyond this year? You mentioned inference, the ecosystem, potentially years and decades of demand. Where is the visibility coming from? What are you seeing in your backlog, in your order books, and in your conversations with customers that give you that confidence?
Yeah, thank you for the question. Yes, I mean, other than generative deep learning segment continue to grow very strong, our inferencing opportunity and general CPU customer base also growing. So with AI continue to be more popular indeed. So many verticals around the world need more inferencing solution as well, including private cloud, private kind of data center, and even personal AI. So we are approaching continue to grow in all different kind of direction, and we see positive feedback, feedback.
Got it. And to ask one of the questions that's been mentioned in a different way, is there a gross margin floor as you pursue this share gain, and when do you see a possible inflection? I'm just wondering what is the limit when you go, in terms of gaining share versus the margin that you're generating?
Sure. So we set out a target back in March of 2021 of 14 to 17, but then and we've actually done pretty well against that target. But one thing I'll say is that we have there's a lot of initiatives that play into our favor. Number one, we're doing a lot in terms of expansion to lower our cost envelope. And number two, our advantage is our building block solutions, and what that means is we're the fastest to market because of the way that we have architected our products. So what that means is there's a lot of new technologies that are coming out, from many different technology providers, and we expect to again, as we were with AI, be first to market with those. And that first to market advantage helps to differentiate ourselves as we come out with a complete set of solutions. So we think that's another thing that is always going to play to Supermicro's advantage.
Yeah, especially we have a so broad building block solution. So the economic of scale will help our building block solution to be more efficient, because there are lots of product line. Our volume was still in the middle size to small size of volume, and we deserve and will continue to be aggressive to grow, to see every segment, every vertical, we have a healthy economic of scale.
Okay, great. Thank you. I will jump back in queue.
Our next question is from Quinn Bolton with Needham. Your line is now open.
Thanks for taking my question. Let me echo the congratulations on the very strong results. I guess I wanted to ask you a gross margin question too. Obviously, it's moderated here in the current quarter and in the forward quarter as you guys position yourselves for further market share gains. I guess my question is, would sort of the midpoint of that 14 to 17% level that you set back in 21, is that sort of the right level to be thinking about as you guys stay aggressive and try to drive market share gains? And maybe a sort of a twist on the question, to the extent that supply catches up to demand and growth rates slow, would you then start to focus more perhaps on higher margin business? Just any sort of thoughts where in that 14 to 17% range margin may trend over the next year or two would be helpful.
Yeah, for sure. Our most important principle is whatever the best for shareholder for the company. So although we set 14% to 17% as the range in 2021, but if any change, any further adjustment will be the best for shareholder, we will do that change. And we are carefully evaluating the range kind of monthly.
Okay. Got it. And then, Charles, a question on liquid cooling, just as you look forward. You guys are ready. It sounds like the infrastructure may still need some improvements, but I guess as you look at data center customers, CSPs that are looking to deploy liquid cooling, does that include current generation sort of 700-watt GPUs, or is it really the next generation, the B100s and sort of the 1,000-watt GPU class that really drives the adoption at your CSP customers, drives that need for liquid cooling?
You are right. Indeed, the current 600, 700 watt per module, people can still take care very well with air conditioning. And that's why people still comfortable with the traditional air cooler. But when the system grows to 1,000 or even more than 1,000 watt per module, yes, I mean, the liquid cooling become even much more critical. So by that time, I believe most of the data centers will have a facility ready for that. So we are very optimistic and very patient to continue to improve our quality, especially the reliability and easy for maintenance. So when customer is ready, we can ramp up quickly to support them.
Excellent. Thank you.
Thank you for the question.
Our next question is from Aaron Rakers with Wells Fargo. Your line is now open.
Yeah, thanks for taking the questions and also great results. Just curious, when you talk about your customer concentration and the diversity of the business, when you talk about 26% and 11% of your revenue coming from two customers, are those the same customers? Like last quarter, I think you had a customer that was 25%, or are you seeing these customers kind of bounce around? I guess the simple question is just, is that the same customer, that 26 versus 25?
So Aaron, the 26% customer is the same customer, but the 11% customer is not a new customer, and it's a longer-term customer, but first time in 11%. And to your point, yes, we do see a bouncing in and out, and we're very happy. Anytime they do bounce above, by the way.
Yeah, and that's why the economic of scale is very important to us. When we further grow our total revenue, we will have a more large scale customer and more middle-sized and small-sized customer as well.
Yeah, and then as a quick follow-up, I'm just curious, as we look at the AI kind of evolution from here, there's a lot more kind of product diversity itself coming out, B100s, GH200, AMD's product lineup. As you think about the growth going forward, would you say that the growth is more ASP expansion driven as we think about these next generation platforms, or does diversity drive more of the growth being driven by unit volume growth? I'm just curious how you would kind of characterize the growth driver, from here going forward on those two inputs.
I guess in next few years, our growth will be quicker in terms of unit number. So the volume growth will be quicker than the ASP. Because last 2 years, our ASP have been growing very a lot, right? So next step, I guess, unit number, volume will grow faster.
Yep. Thank you.
Our next question is from Ananda Baruah with Loop Capital. Your line is now open.
Yeah, good afternoon, guys, and thanks for taking the question. Appreciate it. And congrats on the really solid execution. Yeah, congrats on that. I guess, yeah, two, if I could, Charles, maybe a clarification. I did some math on the 15,000 racks per month, and I came up with, I guess 5.6 billion a quarter. Call it 5.5, I guess, plus or minus, but I came up with 5.6 billion. Is that kind of accurate? And I guess the question is, if it's sort of mid-year, you're talking about getting to that point, is that the kind of run rate opportunity that we can be thinking about quarterly? And not like a guidance, but like an opportunity when you get into sort of the back half of the calendar year? Just want to make sure that we're interpreting that, kind of accurately. And then I have a quick follow-up. Thanks.
Yeah, again, we say we have to make a green computing everywhere. That's why whenever we can help customer base, we will. That's why we have been building a really large-scale capacity for liquid cooling and other green computing solution. So yes, the capacity will be huge, but it's a capacity there. When customer need, we are ready. And indeed, our facility also very flexible. Lots of facility can support liquid cooling and air cool or combination cooling. So yes, we have a huge capacity ready for growth, but not necessarily all for liquid cooling. They support air cool or combination hybrid cooling as well.
Awesome. Thanks for that. And then could you just, I guess the follow-up is, you guys have mentioned a couple times on the call today, sort of new customers as part of, and I think Charles, your words were accelerated growth. And so any complexion, I guess sort of any context on the new customers that you guys are wrapping in to, into your run rate, kind of would be useful. Anything about them, like what, kind of industries, I guess like sort of industries, projects, anything like that would be helpful since they're new. Thanks.
Yeah, thank you. I mean, we spend a lot of effort to make our sales process and operation process, service process be automatic. So those automation systems for sales, for production, for support really enlarge our capacity. And that's why we have a capacity to approach to support more customer now. So, and we need economical scale, because economic scale are very important to our operation margin and overall EPS. So yes, we are ready to grow much quicker even.
Yeah, that's super helpful. Okay, guys, thanks a lot. Congratulations.
Thank you.
Our next question is from John Tanwanteng with CGS Securities. Your line is now open.
Hi, thank you for the follow-up. I was just wondering if there's any changes to your OpEx growth formula. It's been, on a trailing basis, less than half of what revenue growth is. As you grow bigger, do you expect to run against any limits in supporting such a large, customer base and potential customer base, or are you getting more economies of scale as you go larger with that?
Yeah, indeed. We have been a small volume company for too long, a 30-year-old company. So our volume just started to grow in a kind of good economical scale just recently. And we like to take this chance to continue to grow our economical scale. So when our economical scale grows, we leverage automation system, again, for sales, for operation, and for service. And that's why, we are in a good position to continue growing quickly.
Okay, great. And I was just wondering, at the rate of growth that you're seeing, do you expect to need more external financing? I know you talked about other sources of cash. I'm just wondering if you're going to the debt markets, what the plans are to finance this growth.
Yeah, our financing team have been very diligently working out more source, especially try to minimize dilute our stock our equity. So we have a many program kind of well studied and ready there. So when we need more capital, we are ready. David, you may add something.
Yeah, so I'll just echo what Charles said. We're looking at a number of different things, John, and we are mindful of not having further dilution, as Charles said. So we're looking at a number of different opportunities, and the reason we have to is because we need more working capital for growth, and the reason that our cash flows, were not as strong as last quarter was simply because we grew by so much. So when you grow by over $1 billion in a quarter, you've got to have additional working capital. So that's the plain and simple fact.
Our inventory has been growing more than $1 billion.
Yeah.
And we'll continue to grow.
Got it. Thank you very much.
Our last question will be from Nehal Chokshi with Northland. Your line is now open.
Yeah, great. Thanks for the follow-up question. And I actually have two follow-up questions. First, at the September quarter earnings call, I believe you guys said the capacity was around 18 billion. And that's up from 15 billion to June 2023 quarter. Was the driver of that actually increased capacity or increased ASPs? And then in relation to that, your full year guidance that implies a June Q guidance of around 4.7 billion, then implies that your annualized capacity is reaching 19 billion. And so as your capacity is increasing, is this largely A, mix driven, like for like ASP driven, or has your capacity actually gone up prior to Malaysia coming online?
Yeah, I mean, our ASP will gradually continue to grow, while the unit number will grow much faster from now on, I guess. So that's why we need more capacity.
And one thing I'll add, Nehal, is that in December we shipped over 1.8 billion, and so that alone establishes a $19 billion capability.
Okay. And then my other question is that typically going into the March quarter, revenue is seasonally down Q-over-Q. You're guiding it up to be up Q-over-Q. Usually, though, when the revenue is down seasonally quarter-over-quarter, your cash conversion cycle goes on a Q-over-Q basis. This March quarter, however, because you're projecting a Q-over-Q revenue increase, does that change your expectations on cash conversion cycle seasonality dynamics?
Go ahead.
Yeah, because of the demand it is very strong. So we believe this March quarter will be a strong quarter as well.
Dave, did you have anything to add to that?
Yeah, so it really comes down, Nehal, to timing. When we receive inventory and when we ship out. So, as I mentioned in the December quarter, you can have big, big activity even within a month within the quarter, and so that will affect, your metrics.
Okay. Talking about the December quarter, your cash conversion cycle was actually a lot better than what we had expected. And yes, I recognize there was a consumption of cash, but it was at least a lot better than what we had expected. Was that actually better than what you had expected, given the significant revenue upside that you had delivered here?
It absolutely was. Yeah, we had some customer prepayments and things which helped us out.
Yeah.
Gotcha.
Also, when economical scale, when economical scale grow, we can more efficiently leverage our inventory as well.
Right. Okay. Great. Congrats, guys. Thank you.
That concludes today's conference call. Thank you all for your participation. You may now disconnect your line.